Hey everyone, I'm Jeremy Szafron, and this is Kitco News. Don't forget to subscribe to our channel for the latest market updates. Well, on the show today, we take a deeper look at gold and its recent all-time highs. Now, spot prices recently shattered expectations, pushing past that $2,200 per ounce mark. And this isn't just a number. It's a signal, it's a beacon in the financial markets that's drawing both admiration, but also a little bit of scrutiny. Now, today, we're cutting through the market noise with Axel Merk, the Chief Investment Officer and the President of Merk Investments. Axel's recent analysis suggests that behind the glitter of high gold prices lies the strategic moves of central banks and the unyielding dynamics of global geopolitics. So what does this mean? Well, let's break it down now. Axel Merk, thanks for joining us today.
Glad to be with you.
I appreciate your time here, Axel, and I kind of want to just start right off the bat. I mean, we've seen some recent all-time highs. So firstly, let's get into that all-time high, breaking the $2,200 mark. You've been doing this, as I mentioned, for quite a while. What was this exciting for you? Give me your insights here.
Well, the first thing I like to tell people is to take a step back and recognize that gold has not changed. It didn't change today. Right. It actually hasn't changed over the last thousands of years. And so it's the perception of gold that changes. It's the valuation of gold as people try to get more of it. And as you point out, right, governments is one portion of it. We live in a world of increased geopolitical instability. I would argue the relatively peaceful times we've had since World War II are coming to an end. And then, of course, both the political parties have recognized that fiscal spending is the way to get voters, and that ultimately induces the Federal Reserve to have a more inflationary policy, even if they don't want to admit that. And so it's just a symptom of the times, I would say, more than anything else. And I'd just like to add to that, one particular group of buyers has been absent. That's the speculator. Those folks are with the meme stocks and the like. And so sometimes when you see these big moves, says, oh, okay, there's a great trend, and everybody piles into it, and it's as a result often short-lived. That can happen on the way down, by the way, as well. Those guys we have not seen at this stage.
Yeah, no, it's funny that those retail investors have been chasing profits, mostly the Magnificent Seven, it seems, a little bit more on the AI and tech side. Let's get back to gold. What's driving the rise? I mean, we talked a little bit about central bank demand. Obviously, we're seeing that buying in India, China. But is it pure market sentiment, or are we looking at, deeper economic narratives unfolding and perhaps a shift in personal portfolios as well?
Well, it's always sentiment. It's always supply and demand. We try to, for our own satisfaction, I suppose, give it an explanation. And the way I look at it, the two ways is, first of all, I don't have a crystal ball, but I like to recognize risks, see whether they're reflected in the market. If I value them more highly than the market might, then do something about it. But importantly, also, I'd like to understand where price is, because ultimately the market is, quote unquote, always right. So I'm trying to figure out whether I might be wrong. The context in which I see the price of gold is obviously the Federal Reserve. They own the bazooka, and we're coming on the backdrop of the higher for longer environment. Last October, Fed Powell gave what I would call a mission accomplished speech, that they're no longer petrified about the inflation of the 70s, but they can look forward. And ever since then, financial conditions have been easing. And just for context, usually when you have a recession and the Federal Reserve is on an easing cycle, it depends on how much they ease and how bad the economic cycle is. If it's a soft landing, well, risk assets, the S&P 500, tends to discount that and live happily ever after. If we have a hard landing, the S&P tends to go down. People are scrambling more for diversification. Federal Reserve action is more pronounced. People look for diversification more actively. And so what we have now is this slow motion recession that never appears to want to come. And so we have this bias towards an easier policy. We see that reflected in the price of gold, not so much in gold mining at this stage. We can talk about that later. But for the price of gold, it's that future expectation does matter as for any other asset. And what's very relevant is, even if the Federal Reserve doesn't do anything, this continuously pushing down the road, this easing is still beneficial, because the attitude is that they might get easier down the road.
Yeah, it's interesting. I mean, we're at a very crazy time in the world, it seems. I mean, when we look at the Fed cutting rates, we're pricing in possibly 3 towards the end of the year. At least that's what the dot plot points at too. I'm curious, let's take ourselves out of here. We got the Fed, we got geopolitical situations around the world. Is this just a perfect storm? And I mean, a lot of people say what goes up must come down. Are we going to see maybe a correction here?
Well, first of all, I just scribbled down when you mentioned the word dot plot. And remember, a few years ago, the Fed officials told us, ignore the dot plot. It's all
Right.
just an exercise. It's completely irrelevant. Um, Remember last summer, we gave up quote unquote forward guidance only to replace it with a dot plot. And what that does is it creates instability in the market, volatility, because rather than us focusing where inflation employment will be, we're focusing on the utterance of a few words of Fed officials. The reason we do it is, of course, because they do control the bazooka, but it's not a very helpful way to do it. Now, could we have a correction? Of course, we can always have a correction. Um,
Right.
I like to look at the price of gold long term, and I see the incentives of governance misaligned with the incentives of consumers. As I mentioned, geopolitics, I see instability long term. Usually, I don't like to look at geopolitically. There's a confusion or noise too much because when a terrorist attack happens somewhere, price of gold may move up briefly, but then come back down because the market unfortunately gets used to those sort of things. The reason why I think this is a little different is because I look at what's happening in Ukraine and Gaza as just symptoms of a new era that we are in. And unfortunately, I'm afraid that we'll see more of that in different parts of the world, in different incarnations. And so we are creating a different level of instability that may be with us for long term. Perfect storm is a term I'm reluctant to use because there's always the unknown that may hit us even if we think we're in the middle of the storm.
Right. Okay. So geopolitically, it's also bolstering gold prices here a little bit with the uncertainty. But say we have some breakthroughs geopolitically and uncertainties resolve sooner than expected. Will gold start to be overlooked again, or is the buying just fear and worry at this point?
Well, it is still overlooked despite having reached highs. I mean, you see this thing in the crypto world saying, oh, but if everybody only owned 1 or 3% of digital assets, it would go to the moon. Of course, that never happens. At least I don't think so. In gold, it never happened that everybody does it. We don't hear that sort of storyline being told. We do see in the work we do in our shop, and we manage a little over $1 billion in gold and gold mining. We do see there is some interest by retail investors. We do see the diversification investor coming back in 2022. Diversification didn't work so well. We see the fellow who is concerned about the purchasing power of the dollar come in, but none of that in some sort of extreme fashion. It's really on a low burner in many ways, and that somewhat encourages me that we are not in a peak. You don't see speculative acquisitions in the mining side things. None of these are hallmarks of a peak. To your earlier question, could there be a correction? Of course, again, there can always be a correction. The price of gold historically is quite volatile.
Yeah, I mean, you pointed out central bank's significant role in bolstering gold reserves with Turkey and China at the forefront here. What does this intensified buying activity tell us about, the global outlook, particularly in those places? But many people speculating maybe they know something we don't know.
Well, they know exactly what we know. We know that the U.S. is increasingly willing to use financial restrictions as a tool of imposing their national interest or their perceived national interest. I'm not so sure whether it always is what as they say they do. And so what that means is that if you are a nation that's not friendly with the U.S., you have a disincentive of holding U.S. treasuries. Now, that does not mean that they'll sell their treasuries and pile it all into gold. It means that they are in a process that has, in my view, been accelerating to look for alternatives, and gold is but one of the beneficiaries of that process.
Okay, so if the central bank demand wanes and consumers start to lay off purchasing, is this what's bolstering the prices? Are we going to have a big setback on prices if central banks start buying a little bit less gold, or is this a new base at these levels?
Well, it's about supply and demand. Obviously, if you believe that the U.S. will say we got to get rid of sanctions in Ukraine, and by the way, we never did it. But the thing is, the reason why that motion has been put into place is because precedent has been set. Like, you lose trust by one act of not honoring kind of the global rules. Now, you can argue that it's appropriate to sanction oligarchs and Putin. But if you are in their shoes, or more importantly, if you're in the shoes of another person who might in the future be on a sanctions list, including a foreign government, you take note of that, right? And there is no way back from that. It's, of course, the Chinese and others, you cannot simply work without the dollar. They increasingly try to do so. Over time, they might succeed. So it is not something where anybody flips a switch and suddenly the world is different. These are gradual processes. I'm generally not a fan of conspiracy theories because when you say, hey, they know something we don't, the reason I'm not a fan of those is because most of them assume that there's one bad apple. And if you only got rid of that bad apple, everything would be great. Instead, my view is the road to hell is paved with good intentions. I've gotten to know numerous policymakers over the years. They all mean well, but they're hostage of their environment, of how they look at the world. And it's those dynamics that get governments to spend too much. It's those dynamics that have an inflationary bias and a bias to be too late when you tighten monetary policy. And conversely, of course, if you're Chinese, I do not know Chinese policymakers personally, but you do have incentives. It's incentives that drives the world. And so just, if I can just step on that, just one more thing. Right? People were all excited. Oh, what's the Federal Reserve going to do? Well, they cook with salt. They have the same data we do, and these data are very noisy, and they recognize that. And especially the January data released in February, they have so many revisions in them. It's very noisy. And the one way to fix that, by the way, is to look at forward-looking data, except the Federal Reserve has taken those away with its forward guidance. You used to be able to look at the yield curve, and that would give you a reflection of the market. You used to be able to look at the Treasury market to see where there's stress in the system. When the New York Fed intervened to set interest rates, you got rid of that by setting interest of reserves. And all of that creates more fragility in the system, more volatility in the system, because we are relying on these folks to have some wisdom that they do not have.
Interesting. I want to move on to the miners, but before we do that, just a quick comment on, Fed monetary policy here. Obviously, we have PCE numbers coming this week. That seems to be a favorite of the Fed when it comes to policy making. Has anything surprised you with the data? Obviously, we've had, some redactions and a couple of alternative facts here, but has anything surprised you?
Well, if there is a surprise, is that I would have expected more volatility in the data. One thing I agree with Ben Bernanke is that once you have had high inflation, it's not a linear process to go down. And so part of that is Mr. Powell talking about bumpy road. I mean, bumpy is the new transitory we hear. And they will look through that. The question is whether the market will. The market will if the Fed says that they will. And I'm not surprised that the Federal Reserve is slow in the current environment, just because of the framework. I don't like the framework, but in their framework, I'm not surprised that they're slow. And they'll do what the data brings, right? If we have lower inflation and high unemployment, they'll be higher for longer. And if the economy worsens, they will ease. And by the way, just on that note, I bet on the consumer in this. The consumer is stretched. Delinquency rates are rising. So I do continue to think that this economy will perform worse than priced into the markets.
Yeah, well said. We'll obviously keep an eye on those numbers on Friday as well. While the markets are closed, not that they're trying to hide anything, Axel, what does this do for the miners? It seems you've suggested that the ASA fund, which is an investment fund focused on mining companies, has some solid long-term returns, but have mining equities caught up to gold prices here?
Sure, that's a closed-end fund that we manage, and we focus on the junior end of the miners. The bigger miners have had their own challenges, managing costs, having actually a lot of cash, being less leveraged to the price of gold, which many gold mining investors are looking for. The junior miners, in many ways, are also credit plays because they have periodic need for funding. And in the higher for longer environment, they have been suffering. And during that period, we underperformed. Ever since the pivot of which I call the pivot of the Fed from away from the higher for longer last October, they have slowly been outperforming some of the other miners. That said, it's very different from your typical cutting cycle where you have a more pronounced cut. And it is because this economy has been holding more. Those junior miners have benefited from that new stance. In my view, they'll do much better if we have worse economic data, because then the Federal Reserve will be more pronounced. And we saw it in 2009, of course, in an extreme scenario. They tend to react very quickly. to that easier monetary policy. And as long as the policy is more nuanced, they will move, but much less so than many gold investors hope. And indeed, yes, of course, they have been lagging the performance of the price of gold, and many people would have hoped them to perform better, but markets don't tend to do what investors hope.
Yeah, a lot of people calling for a commodities cycle here. Elaborate a little bit on the strategic shift to the ASA fund towards small cap mining companies. You just mentioned cost of capital has been extremely expensive for these companies. So how does this align with your investment philosophy here?
Well, as I mentioned, we have a closed-end fund, and what we are offering is access to junior mining companies. Many of these stocks are rather illiquid, and they have periodic funding needs, as I mentioned, right? As a retail investor, it's very difficult, if not impossible, to participate in these funding deals. We do that quite extensively, and when we participate in these deals, often these companies get a bump rather than falling in share because they get diluted. They get a bump because they have funding for the next 2 years or whatever it may be. In addition, often warrants are issued, which is a win-win for both the investor and the management. If they meet their targets, the share price target in this case, the warrants come into the money and can be executed, which then gives the management additional money for futures. And so we help institutionalize many of these junior mining companies. And then in future funding rounds, to the extent that these companies succeed, then the bigger funds, mutual funds and others tend to participate. Often the companies we invest in are too small. So it's a niche market. We think it's a very important element, and it's something that is attractive for certain types of investors. This is a closed-end fund, so we're not raising your money, so to speak, but we're allowing investors to participate.
Interesting. How hard is it to find legitimate, good junior mining companies out there? Obviously, markets like this, we see some consolidation, a little bit of M&A activity. What's your due diligence process like?
The key is the management team. You need to invest in proven management teams. And that's if there's just one thing to say, right? You can have a brilliant asset, but if you don't know how to get that out of the ground, it's difficult. A prudent management team will understand the local politics unless you satisfy all the stakeholders, which includes the local community and obviously the regulators, environmentalists, and everybody. You'll not get this permitted in any time, right? And so you need a team that has a proven track record of executing. And so that's really key of it. And then there are other aspects that come along. Quite often, these mining companies are near sites of bigger companies. And of course, then the idea is that the big companies have underinvested as they need to, and their own resources get depleted. Acquiring a company like that down the road might be attractive to them. So those are then supplementary considerations, of course.
So some opportunity from the haircuts that we've seen on share prices on the miners. Axel, before I let you go, what lessons do you hope investors and market observers maybe take away from the recent dynamics in gold market? I mean, you have a lot of insight here. What would we like to preach?
Well, I've been in this market for decades now, and investing in any active investing and even passive investing is frustrating at heart. You invest based on, and the way I look at investment is risk allocation. I don't invest that I'll double my money in whatever it is can I afford the risk of investing in the sector? Is that consistent with what I want to do? And what is my goal? And so I can't speak for all investors, of course, and what they're looking for. For example, I invest in both physical gold and gold mining. They have very different risk profiles. They're often lumped together. They all serve their purpose. Now, it has happened to be that the price of gold has outperformed many of the gold miners, and I can now brag at cocktail parties that I invested in gold. And then the next time the gold miners outperform, I could brag that the gold miners outperform. They each have unique risk profiles, and gold in particular is one of these odd assets that with hindsight, it has most of the time served well as a diversifier. You never quite know why you hold that brick that doesn't generate income on its own as an investment. I believe your audience, our investors, clearly recognize that there is potential value in that. And so it's a risk assessment. The one thing, just like to add to that on the volatility, I try to tell people that you should not hold more than you can sleep with at night. And I don't mean the physical gold bar under your pillow. What I mean is that anybody who's been in the space longer knows it can be very volatile. If you get nervous when there's a downturn, it means you may be over allocated to the space.
Well said. Well said. Axel Merk, Chief Investment Officer and President of Merk Investments, joining us. Axel, thanks for coming on and sharing your insight with the audience today. Some great points here as we continue to watch gold.
My pleasure.
Thank you, sir. And thank you for joining us. I'm Jeremy Szafron for Kitco News. Subscribe to our channel and go and like that video. We have plenty more to come. We'll see you next time.